Having rated the borrowers, the important use of the rating is to have a transition matrix which will tell the management, depending on the default percentage which is calculated based on the transition matrix, what is the likelihood of the default in the coming year in a particular rating category. That's an important indication which comes out of the transition matrix. And it basically gives a probability of default in each rate category. And now having measured the risk and what is the relation between the credit risk and the pricing. And we know that the expected loss, which basically comes out of the historical experience or the way we have calculated probability of default multiplied by loss given default, in each rating category has to come from the what is known as a risk-based pricing. Though the first expected loss EL, when you plot a graph of probability versus the losses, has to be loaded on the loan pricing. And then comes why capital is maintained. Capital is maintained not to support the expected losses. Capital, what is known as economic capital or the risk capital, which Basel prescribes, is basically maintained to absorb unexpected losses. But since we are in the business of lending, and anyway we need to recover whatever our expenses are, including the cost of our maintaining economic capital, this has to be loaded on the part of the risk premium again. And beyond that, if there is further loss beyond that, what it indicates is bank is going to default, because anything beyond the loss which the bank incurs beyond the economic capital it has maintained, the bank will not be solvent. So component of the risk-based pricing, basically the cost of funds becomes an important part, and the credit charge basically are coming out of the overhead expected loss charges that we discussed, basically based on the expected loss history. And return on capital, basically the return on capital which is expected because we maintain economic capital to absorb unexpected losses. So these components of the lending rate, what we discussed earlier in a different format I have shown here, to implicate that cost of funds depending on what kind of pricing the bank is using, whether it is having a transfer price mechanism, so it is coming out of that. And expected loss charge based on the probability of default, exposure at default and loss given default, and then return on capital, so because capital is allocated to the unexpected losses. So expected loss charge comes out of probability of default multiplied by loss given default. Return on capital is capital what is required into the hurdle rate. Hurdle rate is basically the expected return, or what we also can call is a internal rate of return. So that is the minimum expected return on the economic capital. So the credit charge again comprises of expected loss charge, overhead, and the return on capital. So let us see, in case suppose a bank has given a loan of 1,000 each to a homogeneous set of 100 borrowers, the total portfolio size will be 100 into 1,000, that is 1 lakh. And if the past history suggests that 5 out of such 100 borrowers default, then the probability of default is 5 divided by 100. That's what we discussed earlier. So there is a possibility that 5% of the borrowers are going to default. Now suppose upon default, if the bank is able to recover 60% of the amount lent, then the loss given default is 1 minus recovery percentage, that is 60%, is 40%. So expected loss charge will be PD, that is 5%, into LGD, that is 40%, that is basically 2%. So in portfolio terms, since we have a portfolio of 1 lakh, it amounts to 2,000 rupees loss on a portfolio of 1 lakh. That what is the expected loss if it is 2%. Now, what is the uses of the credit rating? Important thing is it's used for credit selection and rejection. So the banks will have a policy saying that we will not accept a borrower below a particular rating. Suppose a bank has, say, A1 to A8, it may say that A5 is my entry level and I will not accept any credit below A5, that is A6, A7, A8. You have seen that even the regulators are insisting that once you have started using credit rating for selection of borrowers, it needs to be used for pricing as well. We know that the different rating borrowers have different kind of risk. So the rating, one of the important uses of the credit rating is for pricing. And we have seen it is used for monitoring, and it also decide about the exit strategy. The bank can have a policy that if the particular corporate migrates below a particular level of internal rating, it needs to exit that particular account, sort of give away the exposure to some other bank who is willing to take. And it also helps in assessing the aggregate credit risk profile of the bank, because basically the credit rating represents the credit risk of a particular corporate. So if you know the breakup of the whole credit portfolio rating wise, bank will be able to know what is the kind of portfolio credit risk. Of course, important, some banks have that policy of internal provisions policies, which are basically linked to the internal ratings. So we know that it's used to calculate the probability of default, and it also is an important input for capital charge calculation in case of Basel II, FIRB and advanced approaches. Definitely it is a quality indicator of the credit portfolio, and the banks do have a delegation which are based on the rating. So it's a risk-based delegation. So somebody even in the lower cadre can sanction a loan to a higher rated corporate. That's basically what we mean by risk-based delegation of power. And it is important part is it's a formulation of a strategy based on the composition of the credit quality or credit portfolio of the bank. Now, credit risk control and monitoring. We know that with the credit risk is one such race which the banks have to live with, because that is their bread and butter. So we get return for managing the credit risk. So it becomes very, very important that we have proper risk control and monitoring system when it comes to credit risk. So the important document which has to address the credit risk control and monitoring instruments comes out of the loan policy. Loan policy has to clearly specify the delegation of powers. Credit appraisal process becomes a very key, because that is the level when you are accepting a borrower. So credit appraisal process is an important process in credit selection. Rating standards and entry levels have to be clearly defined. Prudential limits, exposure limits, single exposure, single borrower limits, large group borrower limits, industry-wise limits, all those becomes very, very important for credit risk control. Risk-based loan pricing. So it is not enough to use credit rating only for credit decisions. It is necessary that we need to price the borrower according to the risk and not according to the market. So loan review mechanism is a very important step, because that is where probably we can control a lot of migration of good accounts into bad accounts. Active portfolio management basically talks about periodically checking the credit quality composition of the whole portfolio and taking action periodically, either on the underwriting or intensifying your credit monitoring process. What are the credit risk mitigation techniques? We said credit risk is something which the banks have to live with. So what is important here then is, to the extent possible, without involving additional cost and without foregoing the margins which the banks are earning on the credit, it needs to mitigate the credit risk to the extent possible, because we know that with the narrowing of the interest spreads on the loan portfolio, so any slip in the account or quality of the credit portfolio will affect the interest earning of the bank. So what is securitization? Securitization is an financial securities issued against cash flow generated from pool of assets. Basically, the securitization can be done on any asset which has a future cash flow. Basically, it issues, it creates an SPV, and the cash flows out of the financial assets are transferred to an SPV, and they issue the securities. And collateral loan obligations, they are basically the securities issued in tranches against the loan obligations. As we said, securitization can be for the cash flows out of any kind of assets. Collateral loan obligations are basically the securitization of the cash flows against the loans. And credit derivatives, we know the credit default swaps, total return swaps, credit linked notes, and credit spread options. Let us quickly see each of them briefly just to understand the particular products. Let us see the structure of asset-backed securities. Like we said, any cash flow of an asset can be securitized. Let us take a general example of a pool of having multiple assets, asset 1 to asset 10. It could be loan or kind of bonds or anything, and say it has a total principal amount of 100 crores, and these are basically transferred to what is known as the special purpose vehicle. Now the special purpose vehicle can raise the amount of 100 crores in a different tranches. So I have added the equity tranche here, so to indicate that sometimes equity portion also can be there in a asset-backed security structure. So tranche 1 basically an equity with a principal of 5 crores, and the yield will be the highest amongst the 3 tranches, because this tranche is the one who will get the money last at the end in case of any problem in the repayments of those obligations. And the tranche 2 is known as mezzanine, which has a principal of 20 crores and the yield is 10%. So tranche 3 are super senior. They are the one who will, in the waterfall, they are the one who will receive the repayment first. The tranches which are senior will have a lower return because the credit risk to them is very less. So they are the one who are going to get the first repayment. So they always, their obligations will be honored first before it is paid to tranche 2 and then ultimately to tranche 1. So this is a very simple structure. So it can have equity, it may be without equity. So we can have all the bonds issued in tranche 1, 2, 3, depending on the kind of the market. And it's always very, very difficult to get the tranche 1 where it is subordinate kind of a thing, where the risk is very high. And the credit default swaps is basically very similar to interest rate swap, wherein there is an exchange of interest for another kind of interest, fixed versus floating. But here is basically a protection against a default. Basically, a credit default swap is an instrument which provides you a protection against a credit default. So basically here, the bank having lent a loan to the customer, so needs to, suppose they are not very, very comfortable with the kind of the default risk, it may prefer to buy a credit protection on a particular loan given to the customers. And when it want to do it, basically it has to periodically pay what is known as a credit default swap premium. Periodical, like we pay insurance premium, it has to pay X basis points per year to the seller of the credit protection. Basically, when you buy a credit protection, the bank is transferring the default risk from its book to the seller of a credit protection. The seller of the product protection will pay a zero amount if there is no credit event, and he pays the total amount which is defaulted in case the credit event happens. Credit event is defined by the ISTA, and it can be specific in a particular CDS contract, saying that what are the triggers when the seller of the credit protection has to make the payment of the underlying obligation, whether it is loan or bond. So this is a very simple mechanism of credit default swap. And as we have already discussed, basically why the credit bank should be doing a credit default swap when its main activity is to lend and take care of the credit risk. But sometimes some of the banks who have a lot of funds but not very comfortable with the credit quality of the customers would like to take an exposure, but at the same time want to have some kind of a credit protection. That is where the credit default swap is used. And it's a very good risk mitigant, because you are literally passing on the entire default risk to the seller of the credit protection. In the total return swap, the bank which having lent the money decide to transfer the risk of any depreciation in the value of the loan. So it accepts a fixed benchmark rate and says for that it will pay whatever the customer has agreed to pay, X%, and also pay to the other party who has returned the swap any appreciation or depreciation in the loan asset. The advantage to the bank lender is it is again passing on the default risk, any depreciation or happening, but at the same time it loses the benefit of appreciation in the asset which it has created, either lent or investment. Now the credit linked note, here the issuer is the one who has already issued a loan or a bond, say return on a reference obligation, say 9% coupon plus capital gain or loss. That's the way investment the CLN issuer has done. Having done that, since for whatever reasons it is not very comfortable with the credit quality of the bond, it may decide to look for a buyer of this credit linked note who probably is for a it invests in this bond, but at the coupon payment system will be depending on the quality of the original reference obligation. That's the loan or bond which the CLN issuer has invested. So it says if the original loan obligation has a 9% coupon plus capital gain or loss, the coupon payment which the CLN buyer will do is he will pay 11% if no downgrade of the bond, but the other part is pay the par value if there is no default, or if there is a default, whatever recovery only he gets, he will pass on to the CLN buyer. So here the CLN buyer is exposed to the credit risk on the original loan or bond, for which he gets an additional rate of interest, but he also loses if there is a default. So CLN issuer is protected not only against the default but also against any downgrade. So if there is a downgrade, he will be just paying 6%. So he makes a clear spread of 9 minus 6. So 3% is what the CLN issuer will get even if there is no default, but there is just a downgrade. But in case of a default, anyway he will pass on whatever he has recovered to the CLN buyer. Now the credit spread put option. We have seen that basically internationally the credit spreads are traded in the credit risk market. So basically when the investor and a put purchaser has a bond, he has invested already and now he is looking for a put seller. Basically the put seller receives a premium, put premium, basically like in case of any option, it is an option instrument, basically like in case of any other foreign exchange option product, he has to pay the put premium to the seller. In return, he will get a protection, and the cash flow in case of a credit spread option is notional principal into duration of the bond or the loan into maximum of the credit spread at time t minus strike spread. So there will be a particular strike spread for which the option will be written, and if it goes below that, the put seller has to make good this settlement amount which is cash settled. So this is the advantage, because it is very dynamic and it will keep on changing depending upon the credit rating migration of the underlying bond. So basically the higher the spread, that means the bond loses value when the spread widens. So this is basically the explanation for the kind of a mitigant which is available by way of a credit spread put option. So the put seller, the put purchaser has an option to put this against that put premium whenever the it exceeds the strike spread. Let us check our progress. A corporate has availed a USD loan from an Indian bank for setting up a manufacturing unit in an African country having a foreign exchange shortage. Loan has to be repaid in USD from cash generation from this project, which is in one of the African country. So the bank is exposed to credit risk only, credit risk and foreign exchange risk only. But we know that when some of the countries have this sovereign risk, which can prohibit the local corporates from paying their foreign obligations. And since the bank has lent money to a corporate, so it is exposed to both credit risk and sovereign risk. So D is the correct answer. In a particular internal credit rating grade, out of 500 accounts at the beginning of the year, 10 accounts have migrated into default grade. What is the default percentage in this rating grade? We know that we calculate the probability of default by dividing the number of defaults divided by the total number of accounts at the beginning of the year. So it is 10 divided by 500, that is 2%. So C, 2% is the correct answer. In this previous example, that is 2% probability of default, if the average recovery in defaulted account is 50%, what is the expected loss for this rating grade? We know that the expected loss is calculated by multiplying probability of default into the loss given default. In case the recovery in this default account is 50%, that means the loss given default is 1 minus recovery, that is 1 minus 50%, that is 50%. So 50% of 2% is 1%. So D, 1% is the correct answer. Collateralized loan obligations, CLOs, refer to accepting additional collateral for loans, takeover loans of other bank, issuing of bonds by the bank against non-performing loans. And we know that the collateral loan obligations is a kind of securitization, and it's a securitization pool of commercial loans through a special purpose vehicle. So D is the correct answer. In a CDS, credit default swap transaction, premium is paid to hedge market risk of reference obligation by protection buyer who gets credit default protection of the reference obligation, by protection seller to hedge against the counterparty risk of protection seller. We know that in a credit default swap, the premium is paid by the protection buyer to the protection seller who gets the credit default protection for the reference obligation. So B is the correct answer.